and I'm a fund manager based out here in Singapore, and this will be an update on the Aberdeen Asian Income Fund. The largest weights in the portfolio are to Singapore, Taiwan, and Australia, which are the three highest yielding markets in the region. And from a sector perspective, the largest weights are to financials, information technology, and real estate. Over the past 6 months or so, we've taken down our Australia weighting. We've sliced some of the mining stocks following their dividend payments, and we've also brought down some of our banks' weightings in Australia. That ties into us reducing our financials exposure overall. We've been slicing across our banks holdings as well, following some global headwinds facing that sector. Instead of that, we've been adding to China. So we have initiated Tencent, following their 50% increase to their cash dividends, as well as the attractive valuations we find given the corrections that we've seen in the China market. And we've also increased our exposure to communication services. So we've added to Tencent, as I've just mentioned, as well as Telstra in Australia as well. From a concentration perspective, the top 10 stocks make up about 36-37% of the portfolio. We've seen modest positive gains so far to the end of March, during quite a volatile start to the year. We paid the final dividend of 3.1 pence, which was a 12% increase year on year, taking the total dividend for full year 2022 up to 10 pence per share. This was a fully covered dividend, and we were able to squirrel away a little into dividend reserves as well, which currently stand at just above 40% of annual dividends. For 2023, we're aiming to keep growing the dividend per share and are targeting 10.5 pence per share, which would mean we've grown dividends to shareholders for 15 consecutive years. As discussed, we've made a couple of changes to the portfolio. The fund has been underweight to China as we really struggle to find well-priced, good quality companies that also paid a high yield or were committed to growing dividends to shareholders. The Chinese equity market has corrected substantially over the past 2 years or so, and so we've initiated some internet companies such as Autohome and Tencent, both of which are trading at attractive valuations and are both paying higher dividend amounts as well. And we also initiated SITC, a Chinese shipping company with a strong business moat in the network that they have here in Asia, supporting that growth of trade to and from China. They're also committed to return excess cash to shareholders in the form of high dividend payments, making them one of the highest yielding companies in the region at the moment. Outside of China, we initiated Telstra, the telco operator in Australia, again for its stable earnings growth as well as high dividend yield, given our growing confidence in their business outlook based on their plans around 5G as well as monetizing their infrastructure assets. Elsewhere, we exited Macquarie Group in Australia to reduce our financials exposure, preferring instead to maintain our positions in the somewhat simpler to understand commercial and retail banks at a time when global banking turmoil could see a higher risk of credit growth slowdown and funding cost pressures in the near term. On a similar vein, we also exited our positions in Bank Rakyat in Indonesia, as well as Kasikorn Bank in Thailand. So I'd like to talk about LG Chem, which is listed in Korea. It's one of the top 5 electric vehicle battery makers globally, with a market cap of around $43 billion US. They've got a strong order backlog, and they work with the leading electric vehicle producers globally, such as Volkswagen, GM, Tesla, and Renault. Demand for electric batteries will continue to rise as regulations tighten, driving up that demand for both electric vehicles as well as industrial energy storage solutions. Unlike other battery peers, LG Chem has a cash generative chemicals business as their core, which helps to fund the investments into batteries. This takes some of the pressure off their balance sheet and enables LG Chem to maintain a payout-based dividend policy that lets shareholders benefit from earnings growth in the business through that higher dividend potential as well. In this fund, we also own the preferred share class, and that pays a slightly higher yield versus the ordinaries. So we believe that Asia as a region remains attractive for total return strategies. It's home to some of the world's most attractive companies, and dividends can be found across a broad and diverse range of sectors, geographies, as well as themes as well. Dividends contributed to more than half of total returns in US dollar terms in Asia last year, whilst dividend growth in the region has seen 12% compound annual growth rates over the past 2 decades, outpacing dividend growth in both Europe as well as the United States. In an environment where financial stress could rise, I think this focus on dividends and quality business moats is key to finding the most compelling and sustainable growth stories in Asia, and we'll continue to utilize our team of over 30 analysts and fund managers based here on the ground in Asia to generate new ideas for the portfolio.